Let me tell you what just happened. While most Americans were focused on holiday plans and year-end finances, the Office of the Comptroller of the Currency dropped two proposals on December 30th that could fundamentally reshape how your mortgage escrow account works. This isn't abstract regulatory jargon. This is about the money sitting in your escrow account right now and whether you'll ever see interest on it. Here's the situation. The OCC published two connected proposals. The first is a new regulation codifying what they claim are long-standing powers of national banks to control mortgage escrow accounts. The second is a preemption determination targeting New York's interest on escrow law and similar statutes in 11 other states. These 12 states currently require banks to pay interest on funds held in mortgage escrow accounts. New York's law, for instance, mandates 2% interest on those funds. The OCC's position is clear. Federal law preempts state laws that require banks to pay interest or that restrict fees on escrow accounts. Translation: if these proposals become final, national banks operating in New York, California, Connecticut, Maine, Maryland, Massachusetts, Minnesota, New Hampshire, Oregon, Rhode Island, Utah, and Vermont could stop paying interest on billions of dollars in escrow funds. The comment period closes January 29, 2026. This move didn't come from nowhere. It's the OCC's response to years of litigation and a 2024 Supreme Court case called Cantero versus Bank of America. In that case, the court didn't settle whether state interest on escrow laws were preempted. Instead, it sent conflicting signals that left lower courts struggling to apply a workable standard. Circuit courts have split on this question. The Second Circuit sided with banks, saying New York's law was preempted. The Ninth Circuit went the other way in cases involving California law, ruling that banks must comply. The OCC is now stepping in to resolve the confusion by asserting federal supremacy. The regulatory language matters here. The proposed rule states that national banks have discretion over the terms and conditions of escrow accounts, including whether to pay interest, how much interest, and what fees to charge. The OCC argues this flexibility is essential to the core lending powers granted by Congress in the National Bank Act, the Federal Reserve Act, and the Homeowners Loan Act. They're invoking multiple statutes to strengthen their hand, a calculated move given the current judicial climate's skepticism toward regulatory overreach. Now let's talk about what escrow accounts actually are. When you get a mortgage, your lender typically requires you to deposit extra money each month into an escrow account. That money covers property taxes and homeowners insurance. The lender holds those funds and pays your bills when they come due. It's a risk management tool. Lenders want to make sure taxes and insurance get paid, because unpaid property taxes can result in liens that take priority over the mortgage, and uninsured properties are catastrophic risks. Historically, banks didn't pay interest on these accounts. They held your money, invested it, and kept the earnings. Some states saw this as unfair. In the 1970s and 80s, states began passing laws requiring banks to pay interest on escrow funds. The logic was simple. If a bank is holding your money and profiting from it, you should get a cut. These laws varied. New York's 2% requirement is on the higher end. Other states set rates tied to prevailing savings account rates. The question before us now is whether federal banking law wipes out those state protections. The OCC says yes. Their argument rests on the principle of federal preemption, a constitutional doctrine that says federal law overrides conflicting state law. The test, established in a 1996 Supreme Court case called Barnett Bank versus Nelson, asks whether a state law prevents or significantly interferes with a national bank's exercise of its federal powers. The OCC contends that mandatory interest payments interfere with banks' lending flexibility. They argue that escrow account terms are business decisions, and forcing banks to pay interest or limiting their ability to charge fees constrains their discretion in ways that conflict with federal law. They compare interest on escrow mandates to other state laws the Supreme Court has struck down, like restrictions on insurance sales by national banks. But here's where it gets interesting. The Dodd-Frank Act, passed in 2010 after the financial crisis, explicitly addressed preemption. It gave the OCC authority to issue preemption determinations, but also affirmed that national banks must comply with state consumer financial laws unless preemption clearly applies. Critics of the OCC's proposals argue that Dodd-Frank was meant to rein in aggressive preemption, not expand it. They point out that Congress was aware of state interest on escrow laws when it passed Dodd-Frank and did nothing to preempt them. The timing here is no accident. The current administration has made deregulation a priority, and the OCC is using regulatory and preemption authority to shield national banks from state-level consumer protections. This isn't just about escrow accounts. It's a signal about how far federal regulators are willing to go to centralize power and limit state oversight of financial institutions. Let's put some numbers to this. Approximately 80% of mortgages in the United States include escrow accounts. That's tens of millions of homeowners with billions of dollars sitting in these accounts at any given time. In the 12 states with interest on escrow laws, banks have been paying out or facing lawsuits over unpaid interest for years. If the OCC's proposals go through, that revenue stream for consumers disappears. Think about the individual impact. If you have a mortgage with an average escrow balance of $3,000 and your state requires 2% interest, you're earning $60 a year. Not life-changing money, but it's your money. Multiply that across millions of borrowers, and you're talking about a significant wealth transfer from consumers to banks. The legal battles over this issue have been fierce. In Cantero, borrowers sued Bank of America for failing to pay interest required under New York law. Bank of America argued that, as a national bank, it wasn't bound by state law. The Second Circuit agreed. But in the Ninth Circuit, cases like Lusnak versus Bank of America and Kivett versus Flagstar Bank reached the opposite conclusion, holding that California's interest requirements applied to national banks. The Supreme Court's decision in Cantero was supposed to provide clarity. It didn't. The court reaffirmed the Barnett Bank standard but declined to rule on whether New York's law was preempted. Instead, it sent the case back to the lower courts for further analysis using a nuanced, fact-specific approach. That's lawyer speak for, "We're not giving you a clear answer." The OCC's proposals are an attempt to cut through that ambiguity. By codifying banks' discretion over escrow accounts in a federal regulation, they're creating a direct conflict between federal and state law. If a federal regulation explicitly grants banks the power to decide whether to pay interest, then a state law requiring interest payment arguably interferes with that federal power. That's the preemption argument in a nutshell. Now, let's connect this to broader trends in the real estate market. We're in a moment of extreme financial pressure on homeowners. Escrow payments have skyrocketed. According to analysis from Cotality, a property market research firm, non-mortgage costs collected through escrow accounts jumped 30% in 2025. In states like Florida and Colorado, escrow payments surged 55% and 57% respectively. The primary driver is insurance premiums, which have exploded due to climate-related risks and insurer exits from high-risk markets. This creates a squeeze. Homeownership has already become less attainable due to elevated mortgage rates and high home prices. Now, even those who own homes are seeing their monthly housing costs rise dramatically, not because of their mortgage payment, but because of taxes and insurance. Realtor.com senior economist Jake Krimmel warns that the certainty over stable monthly payments, traditionally a key benefit of homeownership, is under threat. Here's the connection. If escrow costs are rising and banks stop paying interest on escrow funds, homeowners lose on both ends. They're paying more into escrow each month, and they're earning nothing on those deposits. Banks, meanwhile, continue to invest those funds and earn returns. It's a wealth transfer that happens quietly, buried in the fine print of mortgage servicing. The insurance crisis deserves its own analysis. Homeowners' insurance premiums are projected to rise 8% nationally in 2026, outpacing inflation. In disaster-prone states, increases are far steeper. Insurers are pulling out of California, Florida, and Louisiana. Those that remain are raising premiums and reducing coverage. For homeowners in these markets, escrow accounts are ballooning, and there's no end in sight. Property taxes are the other piece. Local governments facing budget pressures are raising property tax rates. In some jurisdictions, reassessments have driven valuations up sharply, triggering higher tax bills. Homeowners who locked in low mortgage rates during the pandemic are now facing payment shock, not from their loan, but from taxes and insurance. This is where regulatory decisions intersect with lived economic reality. The OCC's proposals might seem like inside baseball regulatory maneuvering, but they have real consequences. When banks keep interest on escrow funds, they're extracting value from stressed homeowners at a time when those homeowners are already struggling with rising costs. Let's talk historical parallels. The current debate over federal preemption of state banking laws echoes conflicts that go back centuries. The National Bank Act of 1864 created the dual banking system, where banks could choose between federal and state charters. Charters came with advantages, including preemption of certain state regulations. This was intentional. Congress wanted a uniform national banking system that could operate across state lines without being subject to a patchwork of conflicting state rules. But states retain significant regulatory authority. The balance between federal and state power in banking has always been contested. After the savings and loan crisis of the 1980s and the financial crisis of 2008, there was a push to strengthen state-level consumer protections. Dodd-Frank reflected that impulse. It limited preemption and required national banks to comply with state consumer financial laws unless specific conditions were met. Now, the pendulum is swinging back. The OCC under the current administration is reasserting federal preemption aggressively. This isn't just about escrow accounts. It's about the broader question of who regulates consumer finance. Do states have the power to protect their residents with stricter rules? Or does federal law create a ceiling that states can't exceed? This debate matters because states have historically been laboratories for consumer protection. Predatory lending laws, interest rate caps, and disclosure requirements often start at the state level before becoming federal policy. If federal preemption becomes the default, states lose the ability to experiment and respond to local needs. The result is a one-size-fits-all regulatory framework that may not serve all consumers equally. The OCC's proposals also raise questions about the role of regulatory agencies in the current legal environment. The Supreme Court's recent decisions, particularly Loper-Bright versus Raimondo, have curtailed agencies' ability to interpret ambiguous statutes. The doctrine of Chevron deference, which gave agencies leeway in interpreting laws, has been significantly weakened. Agencies must now demonstrate clear statutory authority for their actions. The OCC is aware of this. That's why their proposals cite multiple statutes and build a detailed legal argument for their authority. They're not relying on broad grants of discretion. They're pointing to specific provisions in the National Bank Act, the Federal Reserve Act, and the Homeowners Loan Act that they claim support their position. Whether courts will accept this argument remains to be seen. Legal challenges are inevitable. Consumer groups, state attorneys general, and potentially some banks that benefit from state laws will file comments opposing the proposals. If the OCC finalizes the rule, lawsuits will follow. The litigation could take years to resolve, and the outcome is uncertain. Now let's follow the money and talk about who wins and who loses if these proposals become final. National banks and federal savings associations are the clear winners. They gain complete discretion over escrow account terms. They can choose not to pay interest, charge fees, and invest escrow funds, however they see fit. This increases profitability, particularly for large institutions that service millions of mortgages. For context, the largest mortgage servicers in the United States include Wells Fargo, J.P. Morgan Chase, Bank of America, and Rocket Mortgage. These institutions collectively service trillions of dollars in mortgages. Even a small margin improvement from eliminating interest payments adds up to significant revenue. For shareholders and executives, this is a win. For borrowers, it's a loss. State-chartered banks face a different situation. If they're not covered by the OCC's preemption determination, they may still be required to comply with state interest on escrow laws. This creates a competitive disadvantage. National banks can offer slightly lower mortgage rates or fees because they're saving money on interest payments. State banks can't match that without violating state law. Over time, this could drive business toward national banks and erode the state banking system. Consumers in the 12 affected states lose the most. They lose interest income they were entitled to under state law. They also lose leverage. If a bank knows it doesn't have to pay interest and can charge fees, there's less incentive to compete on escrow account terms. The market becomes less consumer-friendly. There's also a fairness issue. Not all states have interest on escrow laws. Borrowers in states without such laws never received interest. The OCC's proposals create national uniformity, but it's uniformity at the lowest common denominator. No one gets interest, rather than everyone getting interest. Consumer advocates argue this is the wrong direction. They point out that banks are already highly profitable, and that escrow interest requirements don't impose significant burdens. Paying 2% interest on escrow funds is a modest cost compared to the overall economics of mortgage lending. Banks factor these costs into their pricing. Removing the requirement doesn't necessarily translate into lower rates for borrowers. It's more likely to boost bank profits. The political dimensions are also worth considering. The 12 states with interest on escrow laws skew toward states with more active consumer protection frameworks. New York, California, and Massachusetts are not traditionally banking-friendly environments. They have strong attorneys general who aggressively enforce state consumer protection laws. The OCC's proposals are a direct challenge to that state-level enforcement authority. State attorneys general are likely to push back hard. They'll argue that the OCC is overstepping its authority and infringing on state sovereignty. They'll point to Dodd-Frank's explicit recognition of state consumer financial laws. They'll note that Congress has never passed legislation preempting interest on escrow requirements. If Congress wanted to preempt these laws, it could have. The fact that it hasn't suggests Congress believes states should have this authority. The banking industry will defend the proposals vigorously. Industry groups like the American Bankers Association have been lobbying for preemption for years. They argue that the dual banking system creates compliance burdens and that national banks shouldn't be subject to 50 different sets of state rules. They want uniformity, and they want it on their terms. This is where the regulatory capture argument comes in. Critics of the OCC's proposals will say that the agency has been captured by the industry it regulates. When an agency issues rules that heavily favor regulated entities at the expense of consumers, that's a red flag. The OCC will counter that they're simply clarifying existing law and that their proposals reflect sound policy. But the optics are bad. Issuing these proposals at the end of December, when public attention is low, doesn't help. Let's also talk about what this means for mortgage lending more broadly. Escrow accounts are just one piece of the mortgage servicing business. Servicers handle billing, collect payments, manage escrow accounts, and deal with defaults. It's a business with thin margins and high operational complexity. Servicers make money through servicing fees, float on escrow funds, and various ancillary charges. If servicers lose the ability to earn on escrow float in some states but not others, that creates operational complexity. They have to track which accounts are subject to interest requirements and which aren't. Eliminating state-level requirements simplifies operations. That's a real benefit to servicers, though it's not a benefit that necessarily gets passed on to consumers. There's also the question of what happens to existing litigation. Borrowers in states with interest on escrow laws have filed class action lawsuits against national banks for failing to pay interest. Some of these cases are still pending. If the OCC's preemption determination is finalized, it could effectively kill those cases. Preemption is often retroactive. If federal law preempts state law, then the state law was never enforceable against national banks. Courts dismiss the claims, and borrowers get nothing. This is one of the reasons banks are pushing for these proposals. It's not just about future savings. It's about closing off current liability. Every pending lawsuit represents potential damages, legal fees, and reputational risk. A preemption determination wipes that slate clean. Now let's consider the macroeconomic context. We're in a period of elevated interest rates. The Federal Reserve has kept rates high to combat inflation. Mortgage rates, while down from their peak, remain elevated compared to the ultra-low rates of 2020 and 2021. Housing affordability is the worst it's been in decades. The median home price is near record highs. The median household income hasn't kept pace. First-time buyers are getting priced out. In this environment, every dollar matters. Losing $60 or $100 a year in escrow interest might not sound like much, but for a family living paycheck to paycheck, it's real money. It's groceries. It's a tank of gas. It's part of the slow erosion of financial security that millions of Americans are experiencing. This connects to the broader housing crisis. We have a supply shortage. Builders haven't kept pace with household formation. Zoning laws restrict new construction in many high-demand areas. Investors and institutional buyers are purchasing single-family homes, removing them from the owner-occupied market. Rents are high, making it hard to save for a down payment. And now, even for those who do manage to buy, the costs of ownership are rising faster than incomes. The escrow crisis is part of this picture. Homeowners who thought they could afford their payment are facing steep increases as insurance and taxes rise. Some are forced to sell. Others cut spending elsewhere, which slows economic growth. The dream of homeownership as a path to wealth is under threat. Let's talk about insurance in more detail, because it's the elephant in the room. Climate change is driving up insured losses. Hurricanes, wildfires, floods, and severe storms are more frequent and more expensive. Insurers are paying out billions in claims. In response, they're raising premiums, tightening underwriting, and exiting risky markets. In Florida, multiple insurers have gone insolvent. The state's insurer of last resort, Citizens Property Insurance, is overwhelmed. Premiums have doubled or tripled in some areas. In California, State Farm and Allstate have stopped writing new homeowners policies. Homeowners in wildfire-prone areas can't get coverage at any price. Without insurance, you can't get a mortgage. Without a mortgage, you can't buy a home. The market freezes. This isn't a problem that regulatory changes alone can solve. We need massive investments in climate adaptation and resilience. We need building codes that require fire-resistant materials in wildfire zones and flood-resistant construction in coastal areas. We need better land use planning that discourages development in high-risk areas. We need a rethinking of how we price risk in the insurance market. But none of that is happening fast enough. In the meantime, homeowners are stuck paying the bill. And when banks stop paying interest on escrow funds, that bill gets a little bit higher. Property taxes are another pressure point. Local governments rely on property taxes to fund schools, police, fire departments, and infrastructure. As property values rise, so do tax assessments. In some states, property tax increases are capped by law. In others, they're not. Homeowners in rapidly appreciating markets face sticker shock when their tax bills arrive. There's a distributional issue here. Property taxes are regressive in the sense that they're based on property value, not income. A retiree on a fixed income and a high-earning professional might own similar homes and pay similar taxes, even though their ability to pay is vastly different. When property values surge, retirees can get taxed out of their homes. This ties back to escrow accounts. If your escrow payment goes up because of a tax increase, you're immediately affected. There's no time to adjust your budget. The lender recalculates your payment, and next month's bill is higher. If you're also losing out on escrow interest, the financial hit is compounded. Now, let's talk about the potential for regulatory arbitrage. If the OCC's proposals go through, we'll see national banks market their status as a selling point. They'll advertise that they have the flexibility to offer competitive escrow terms. State banks, constrained by state law, will struggle to compete. Over time, this could lead to consolidation in the banking industry, with more assets concentrated in large national banks. That's not necessarily good for consumers or the economy. Smaller state banks often have closer ties to their communities. They're more likely to lend to local businesses and individuals. They provide personalized service. If they get squeezed out by regulatory disadvantages, we lose that localized banking infrastructure. There's also a systemic risk angle. Concentrating more assets in a handful of large institutions makes the financial system more fragile. If one of those institutions fails, the ripple effects are catastrophic. We saw this in 2008. The too big to fail problem hasn't gone away. It's gotten worse. Let's return to the immediate question of what happens next. The OCC's comment period is open until January 29, 2026. Consumer groups, state governments, and industry participants will submit comments. The OCC will review those comments and decide whether to finalize the proposals, modify them, or withdraw them. Given the political environment and the OCC's stated commitment to reducing regulatory burden, it's likely the proposals will be finalized in some form. There may be minor tweaks to address specific concerns, but the core policy is unlikely to change. Once finalized, the rules will take effect after a notice period, likely in mid to late 2026. Legal challenges will follow almost immediately. State attorneys general will file suit, arguing that the OCC lacks authority to issue the preemption determination, and that the regulation exceeds the OCC's statutory powers. Consumer groups will join those suits. The cases will be consolidated in federal court, possibly in the D.C. Circuit or another appeals court. The litigation could take years. In the meantime, the rules will be in effect unless a court issues an injunction. Banks will stop paying interest on escrow accounts in the affected states. Borrowers will file complaints, but their legal options will be limited. The regulatory landscape will shift, and by the time the courts issue final rulings, the status quo will have changed. This is how regulatory battles play out. They're slow, technical, and often invisible to the general public. But the outcomes matter. Decisions made in Washington by unelected regulators have real consequences for ordinary people. Let me bring this back to the bigger picture. The fight over escrow account interest is about more than escrow accounts. It's about power. It's about who gets to set the rules for consumer finance. It's about whether states can protect their residents from practices they deem unfair, or whether federal regulators can override those protections in the name of uniformity and efficiency. It's also about whose interests the regulatory system serves. Is it designed to protect consumers, or is it designed to facilitate the profitability of financial institutions? The OCC's proposals suggest the latter. They're framed as clarifications of existing law, but they represent a significant policy shift. They take money out of consumers' pockets and put it into banks' balance sheets. Historical context matters here. The last time we saw this level of aggressive preemption was in the years leading up to the 2008 financial crisis. Federal regulators systematically preempted state consumer protection laws, arguing that states were interfering with banks' ability to innovate and compete. States tried to crack down on predatory lending, subprime mortgages, and risky underwriting. Federal regulators blocked them. We know how that story ended. The housing market collapsed. Millions of families lost their homes. The economy plunged into the worst recession since the Great Depression. Taxpayers bailed out the banks. The lesson was clear. Unchecked deregulation and regulatory capture lead to disaster. Dodd-Frank was supposed to prevent a repeat. It strengthened consumer protections, created the Consumer Financial Protection Bureau, and reined in preemption. For a time, it worked. But now, the momentum is shifting again. Regulators are rolling back protections. Industry is reasserting its influence. The conditions for another crisis are being laid. I'm not saying the escrow account rule will cause a financial crisis, but it's part of a pattern. It's one more step away from accountability and toward a system that prioritizes profits over people. Let's also consider the political economy of this moment. The current administration came into office with a deregulatory agenda. Agencies across the government have been tasked with reducing regulatory burdens on businesses. The OCC's proposals fit that mandate. They're presented as removing unnecessary restrictions and giving banks flexibility. But flexibility for whom? Banks gain flexibility. Consumers lose protections. That's a trade-off, and it's not obvious that it's the right one. The burden of proof should be on those proposing to eliminate consumer protections. They should have to show that the benefits outweigh the costs. In this case, the benefits accrue to banks and the costs fall on consumers. That's not a balanced equation. There's a broader philosophical question about the role of government in markets. Should government set baseline standards and enforce them? Or should it step back and let market forces determine outcomes? The deregulatory view holds that markets work best when government interference is minimized. Competition will drive innovation and efficiency. Consumers will benefit from lower prices and better products. The consumer protection view holds that markets fail without adequate regulation. Information asymmetries, market power, and externalities mean that unfettered markets don't produce optimal outcomes. Consumers need protections to ensure fairness and prevent exploitation. Regulation is necessary to correct market failures. Both views have merit, but the devil is in the details. What counts as excessive regulation? What counts as necessary protection? These are judgment calls, and they depend on values and priorities. The OCC's proposals reflect a set of values that prioritizes industry flexibility over consumer protection. Reasonable people can disagree about whether that's the right balance. What's not in dispute is the factual impact. If these proposals are finalized, consumers in 12 states will lose interest income they currently receive. Banks will gain that income. The wealth transfer is measurable and significant. So, where does this leave us? The OCC's proposals are moving forward. The comment period will close soon. Finalization is likely. Legal challenges will follow, but they may not succeed. In the meantime, homeowners are dealing with rising costs and shrinking financial margins. The escrow account issue is a small piece of a much larger puzzle. Housing affordability, climate risk, insurance availability, tax policy, and financial regulation are all interconnected. Changes in one area ripple through the system. We're living through a period of significant stress in the housing market. Decisions made now will shape the market for years to come. As someone who's covered financial crises and regulatory battles for decades, I can tell you this. Pay attention to the details. Understand the incentives. Follow the money. When regulators propose changes that heavily favor one side, ask yourself why. When industry groups lobby for regulatory relief, look at who benefits and who pays the price. The escrow account proposals are a case study in how regulatory policy gets made. They're technical, complex, and easy to ignore. But they matter. They affect real people in tangible ways. And they're part of a broader struggle over the future of consumer finance in this country. This story isn't over. The next chapter will be written in the courts, in Congress, and in the lived experience of millions of homeowners. Whether that chapter is one of accountability and fairness, or one of deregulation and wealth concentration, depends on the choices we make now. If you found this analysis valuable, share it with someone who needs to understand what's happening beneath the surface of the real estate market. This channel exists to bring you the stories others miss. Subscribe, hit the notification bell, and let me know in the comments what you want me to dig into next. Until then, stay informed, stay skeptical, and remember, in finance, nothing happens by accident.